Mortgage rates are surging right now, which is leading many to ask the question, number one, why are mortgage rates surging? Why are they ticking up after so long of being steady and falling down? Number two, does this mark the end of the housing bubble? Are we about to start seeing housing prices collapse, real estate crumble as mortgage rates take off and mortgages and real estate as a result start becoming more and more unaffordable? So in this video, we are going to talk about both of those things. Number one, why are mortgage rates surging right now? And number two, what is going to happen to real estate as a result? Ready? Let's dive in. Take a look at this chart with the mortgage rates right now. We see 30-year at about 3.45%, and we can see that that is significantly higher than where it was even just a couple of weeks ago. At the end of December, mortgage rates for 30-year mortgages were just over 3%. Now, if we zoom out here to look at the last 10 years or so, we can see that while mortgage rates aren't near what they have been on average for the last 10 years or so, this is still a significant and a quick spike in rates. It's also important to take a look back at the last couple of decades and notice the very long-term trend in what mortgage rates have done really since they peaked in 1980. So that is the first question that we are answering, is why are mortgage rates doing what they are doing? And the answer is, like so many things today, goes back to the Federal Reserve. The Federal Reserve started the taper in November. For anybody who's not aware, the taper is a reduction of the assets that they are purchasing. For the 15 months prior to November, the Federal Reserve was buying around $120 billion worth of assets every single month, and about $80 billion of that was treasuries. Another $40 billion of that was mortgage-backed securities. That means that the Federal Reserve was actively buying mortgages, sending money through to mortgages to buy them up, which keeps the rates low. How does that work? Well, a mortgage is debt, and the price of a debt instrument is inversely correlated with the interest rate on that debt. Here's a demonstration of that. If I borrow $100 from you, that's a bond. That's a debt instrument. I owe you $100. Let's say the interest rate on that is 1%. That means when the debt comes due, I'm going to owe you $101. You can sell that debt if somebody wants to buy it from you, and that means if you sell it, now I owe that money to somebody else. So how much are you going to sell that for? Well, let's say that you sell it for $101 because somebody really wants that debt. That means the price goes up because I borrowed $100 from you. You can sell that for $101. Now, that person that bought it, they paid $101 for something. How much am I giving them? Still $101. I'm not increasing the amount that I owe upon maturity of this debt just because he paid extra for it. So his interest rate is 0% because the price of the bond went up. He paid $101 for it. The interest rate went down from 1% to 0%. So the Federal Reserve has been a buyer of mortgages that has been bidding up the price. Again, all else being equal, if you have extra money come in to buy something, that makes the price rise. And since it's debt, that means the interest rates have been lower. So buying mortgage-backed securities has been one of the key tools the Federal Reserve has been using to keep mortgage rates low. Why would they want to keep mortgage rates low? Well, number one, when mortgage rates initially dropped in 2020, there were pretty much every homeowner was able to refinance. That did a couple things. Number one, left more cash in everybody's pockets at the end of their paycheck because it lowered their monthly mortgage. Or number two, a lot of people were able to do a cash out refinance, which meant they got a lump sum payment from being able to take some of the equity out of their house and still maybe not have an increase in their mortgage or maybe even a decrease as well. And so by keeping mortgage rates low, that injected a ton of cash into the American economy from all the homeowners who were able to take a reduction on their mortgage or get a cash out refinance. So that was one of the major tools, stimulus tools the Fed used to inject cash into the economy to respond to 2020. Another thing that mortgage rates being low did was it allowed many new people to buy homes, especially before home prices had a chance to really skyrocket and respond to the lower rates. Because if rates get lowered, that means the affordability on the payment goes down. Even if the house price increases some, many times people can still afford higher and higher home prices just because the payment is lower, because the mortgage rate is lower. There's a smaller amount of your payment devoted to interest. This, along with the supply shortage from an inventory shortage from the building side of things, not enough new homes getting built for the people who want a place to live, has led to a skyrocketing real estate market where housing prices everywhere are going up. And now we are seeing the reverse start to take place. Mortgage rates are starting to surge, they're starting to climb, which looks like it might be marking the end of this crazy housing bubble. So how does this play out? One of two ways. The first way this plays out is that the Federal Reserve has finally found religion. They've decided that they are going to do the right thing for the economy, for the American people, long term, regardless of the short-term pain, the short-term consequences, and they sell everything off of their balance sheet, that, $8 trillion worth of assets they're holding on their balance sheet. They let interest rates respond to what the market would set them freely without controlling them themselves, and do not print any more money for bailout of insolvency or bankruptcy or failed economic actors. If they do this, that means that the recession and the crash will take over. We will have a deflationary death spiral. There will be massive economic pain. Even though it'll be short term, it will be massive economic pain, and the prices of everything will collapse, assets, goods, services included. That is possibility number one, which in my opinion, given the track record that policymakers have shown over the last, let's say, just even 20 years, I think is so close to zero chances of coming true that I'm basically willing to bet on it being zero. Because when push comes to shove, policymakers will always choose the least painful option short term, regardless of the long-term consequences, which brings us to possibility number two. Possibility number two is that the rise in interest rates starts to cause economic pain. It starts to cause a market crash. Some major corporations, maybe even some financial institutions, potentially on the other side of the world, are bankrupt. They're insolvent. They say, hey, we need a bailout. Something crazy happens. You start to see a domino effect start to push over some major players. Suddenly, everybody reverses course. Interest rates slammed back down to zero. Instead of selling things off of their balance sheet, they start buying things onto their balance sheet at a rate that makes $120 billion a month look like child's play. Mortgage rates getting pushed down to 2% or 1%, potentially even lower, all in the effort of bailing out the economy one last time before it overdoses on the stimulus. And that is why I am not concerned at all about the surge in mortgage rates, because real estate takes far longer to respond to things like this than the stock market does, than the bond market does. We are far more likely to see insolvency and bankruptcy and some major crash happen elsewhere that causes the Federal Reserve to reverse course before we see any of these problems show up in the real estate market. On top of that, most people in real estate right now have more equity than they ever have, especially when you're comparing it to 12, 13 years ago. Nobody had equity back then. And so even if things do take longer to respond than I am anticipating, which I imagine things to start going downhill this year, there's still a lot more cushion, a lot more wiggle room in the real estate market than there is in something like the stock market, the bond market, major financial players around the world. And the bottom line is, long-term throughout history, whenever you have policymakers who have an incentive to benefit themselves and screw over somebody else, and they're the ones in charge and able to do that, they will always take the route that will benefit themselves. And the government, large corporations are the most indebted, and so when push comes to shove, they will choose the route that benefits the borrowers and not the lenders. This means they're choosing inflation over deflation, and anytime you look back through history at periods of inflation, real estate and land do extremely well. So that is my analysis of real estate right now, and despite the fact that mortgage interest rates are surging, I do not think this has a lasting impact on real estate, and it looks like it's still a fantastic hedge against what is coming down the road. I'll let you know if anything changes. As always, I really appreciate you guys. Thanks so much for watching. Have a great day.